Hello finance students. This week we're going to get more in depth on capital budgeting questions and think about some different kinds of analysis we could do using this framework more than just valuing projects. So for example, in this video we will look at sort of a quintessential example of a hypothetical project that we're going to run the numbers on. But then we'll also do something called equivalent annual cost, where we'll look at how much there's different options for how much a support machine might require, and we'll find the cheapest option among those options. Okay, as you see here, I've got a problem set up for us. So when we do a capital budgeting project, we want to start with revenues and work our way down and make an income statement. Now in this video I will try to be more specific about the kind of things I'm doing in Excel. I will also post the sheet to Blackboard so you have an example of what one with all the bells and whistles might look like. So in this problem we have a project and it has expected revenues of 3, 5, 6, 6, and 2 million in that order. So in years 1, 2, 3, 4, 5, we are expecting 3, 5, 6, 6, 2. Okay, so those are our revenues that are expected to come in. And so it's really good to label these carefully. So that's revenue. Oh, sorry, that's year, right? Year, and then below it is revenue. So if you mouse over the edge of a cell and get that little plus shape, you can move things down. All right, so when we do an income statement, the next line typically is something like variable cost. And so in our case, variable cost is going to depend on the variable percentage. So variable percent. So it's the percent of sales that are spent on cost of goods sold or cost of sales. And in this problem, variable costs are 50%. That's here, right? Variable costs are 50%. So I'll write that here. And then over here, I will say this cell should be 3 million times, so asterisk, 50%. So I clicked with my mouse button and highlighted that cell. And now I want that not to move, so I'm going to push F4. And I get my 1.5, right? 1.5 is half of 3, 50%. And that way, if I change this to 40%, then it will automatically update the variable cost to the new number. So, and because I used F4, if I mouse over the lower right hand corner and get a black plus, and my mouse has changed to a black plus, I click and drag and it will fill all these to the right, right? So half of 5 is 2.5, 3 is half of 6, 1 is half of 2. Okay, and in fact we can do that dragging to the right at the end in a group. So we just do one income statement and then we apply the same logic throughout all of the years. So we have variable costs. Next we need fixed cost in dollars. That's given information in this problem. Fixed in dollars is 1 million. So you might be tempted to say, well, why don't I just put the 1 here? But the problem is that then it doesn't update. If I change this to 2, right, it won't update my work on the left. And another tempting version is to do this and then just make all the other cells equal to that one. But then you're not sure which cell of all these cells is the one that changes it, right? If I change this, it doesn't do anything other than change these, the last 3. Right, but that we don't want that. We'd have to know to change this one. And so it's really just better to make it point at a data column so that you know all of the locations where you can change your data. If you want to be dramatic, you can even make this highlighted or something. And that's pretty ugly, but we'll do a nice green. There we go. So we have revenue minus variable minus fixed is EBITDA. Okay, so we can go ahead and calculate that right now. So revenue minus variable minus fixed, we get our EBITDA, and this will drag to the right at the end of the problem. So after we calculate EBITDA, next up is depreciation. So for depreciation, we need an initial cost. So the initial cost for the capital for this project is $10 million. Oop, I'm going to change this to 6. And the reason is because at 10, it's a horrible failure and you should never do it. So we want it to at least be close. So I have initial cost of 6. And so that means now my depreciation is going to depend on the economic life of the asset. So this problem, it says it's in the Macker's 5-year class. The equipment is in the Macker's 5-year class. So that tells you what the percentages should be in each year. So actually, if you go to Macker's under Wikipedia, they have a nice table. It shows you what kind of things are in the 5-year class. So computers, drilling equipment, aircraft, lots of different kinds of things. They're generally equipment for a business will fall under either 5-year property or 7-year property. Obviously, there's exceptions, but in this case, we're in the 5-year class, and so that means our percentages come from this table. So we have 20, 32, 19.2, 11.52, 11.52, 5.76. And so we'll put that data right in our sheet here. So we have 20%, 32%, 19.2%, 11.52%, 11.52%. Now what was it? 5.76%. 5.76% isn't right. It would go here. It would go here in year 6, but there is no year 6 for this project. So that last 5.76% is never going to get taken as depreciation. We're selling the machine before it is fully depreciated. And so you'll see where the 5.76 happens. It will get into the problem, just not in the income statement portion of the problem. So we have our depreciation percentages here. So next we can do depreciation dollars. And depreciation dollars are equal to depreciation percent times initial cost. And this is over in the green region, so we'll want to hit F4 to lock it in. And that means of our 6 we spent, 1.2 is our breakage allowance in year 1. And if we fill to the right, we will get all the ones for the different years. So here we have more depreciation in year 2 and then less as time goes on. That means we can now do EBIT, which is just the sum total of EBITDA minus depreciation dollars. So we have a loss. We were experiencing a loss in year 1, which is not that unusual for a new project. Next, after EBIT, we need to take off tax. That means we need tax dollars, and tax dollars are based on tax percent, and tax percent is given in the question as 20%. So this is a firm that probably has some significant capital expenditures, and so they have maybe some phantom depreciation to reduce their tax burden. So even though federal rates, their federal rate, their listed federal rate is probably higher, their effective rate can be lower because they have a tax advantage status based on their business. Okay, so tax dollars here, let's say tax dollars are equal to EBIT times, once again, the tax percent, right, which we'll do 20%, F4, lock it in, or Command T on a Mac. There we go. So now, because we have EBIT and tax, we can calculate net income. So net income is EBIT minus tax. Now, Negative tax, does that make sense? The answer is yes. So what that means is we have a loss, and therefore we get a tax refund from the government for tax that we paid previously. Now, there is no previous data for this question, but because this is a project and not a business, chances are almost assuredly that there was tax paid by the parent company, right? So the parent company that's starting this project has revenues, has profits, has taxes, and so the negative pre-tax earnings for this company will provide a tax shield to the parent company sponsoring it. So actually, even though we're losing $700,000, it's actually only losing $560,000 because we provide $140,000 of tax refund to the parent company. In fact, there are companies that are worth purchasing because they have accumulated tax losses that could be used to offset gains by the company who purchases them. It's a transaction that happens sometimes. Okay, so we have net income. So next we need to put depreciation dollars back. Right, this is a non-cash charge and we're trying to get to cash. So I'm going to take net income and add depreciation dollars and get our net cash flow. And this will be the cash that we will use to do NPV and IRR. So next we just need to fill to the right. So I'll mouse over the lower right hand corner and get the black square. Go to the right, and we'll do this. And go to the right. So now we have our money showing up each year in terms of net cash flow. So now, now though we have a couple more features we need to include in this problem. So if you notice over here, it says that working capital will be $1 million to start and then $3 million in year 3. So we need to take account of this working capital cash flow, which is often 0, but in year 3 it's -3. And at the end we get it back. So that's a positive 4, right? We're going to kick in 1 at the start, then we're going to kick in 3, and then at the end we'll get 4 back. So that's the working capital cash flow. And we also have a salvage cash flow, which we need to calculate separately. So the dollars from salvage are, it says 2.5 million. Okay, so there's our dollars from salvage. But we need to know the book value of the asset. And the book value of the asset is the value, what's the value of the asset currently on the books. So what did it start as? It started with a value of 6, right here. Started with a value of 6. So that's what it started as, but it has broken over time. Right? We've taken breakage allowances in the form of depreciation over time. And so the current value is not going to be 6. We need to subtract off all of the breakage we've taken, the depreciation dollars. Now once I hit enter, you'll see this is a number that, right, so we don't really recognize this, but if I divide this by 0.0576, we get 6 back. Why? Because this is that remaining 5.76% of depreciation. Right? We never took it, so that's what's left in the book value. Okay? So what happens according to the government when you sell something worth $345,000 for $2.5 million? You have a gain. Right? We made money on this sale according to the government. And so we take the salvage and we subtract the book value and get the gain. Okay, so just to be clear, right, we took a $6 million asset and sold it for $2.5 million. So we didn't make money. However, according to the government, we did because we have been offsetting income the whole time for breakage allowance, right, for depreciation. So you're not allowed to shelter income and then claim you lost money even though you made a gain compared to where the government thought you were. Right, so on the taxes, this is going to be a gain. So what we'll do, so naturally if we make a gain, we're going to be taxed on it. So we need to find the tax dollars of that gain. The tax dollars of the gain will be the gain dollars times the tax rate. So there's our tax. So we can then do so now we have gain and now we have tax, so we can do the after-tax salvage. And the after-tax salvage is the cash. So is book value cash? No. Is gain cash? No. Is tax cash? Yes. Is salvage cash? Yes. So I will take positive salvage minus negative tax, and that is my revenue from selling the machine. Right, so put that in there. And so now I can get a total cash flow, which is just the sum of all these things. Oh, sorry, so we're just real quick. Yeah, I just did equal sum, drew a box, enter. These blank ones will just come in as zeros. Right here, we're losing some money because we had to kick in that extra working capital. But then at the end, we're kicking back with a big dollar amount. And so next we need to do the NPV. So there's a couple different ways to do NPV, right? The way you'd be familiar with, right, is we go equals. Well, first we need to find the present value of these things, right? So we say this divided by 1 plus r, which our WACC. Oops, I didn't put it in yet. It's going to go right there and lock it in to the power of the year. Okay, our WACC, that's our cost of capital for this project, is 11%. Okay, and so once I've done that, I can get the little black plus by mousing over the lower right and drag to the right and get present values. So then our net present value is the sum of these present values minus the 6 we spent for initial dollars minus the 1 we spent for working capital, right? We had to kick 1 million in at the start. And that's how working capital works generally. You put money in over the course of the project, and then you get it out towards the end of the life when it's winding down. So working capital is negative at first and positive later, and it sums to each other, right? I have -1 and -3 and +4, so that sums to 0. So it's tempting to think that that's kind of a neutral, but it's not, because the money we pay early, and the money we get late. And so in time value of money sense, we end up negative. Right? We basically have money tied up in the business that could be earning interest, and so there's a real dollar cost to having working capital tied up in the business. Okay, so we have a negative 116, negative 1.16. And this is, right, this helps inform our decision here. Is it a good idea to do this project? Probably not, right? This is a negative NPV, and so if the company undertakes this project, they will end up in trouble because they don't have they've cost themselves $1 million of value. It also asks for IRR, so we can calculate that. Just real quick, another way to do the NPV function is to say equals NPV, and then you give it the rate, and then you draw a box around the cash flows, not the PV ones, just the actual cash flows. And then you have to subtract off the 6 and the 1 yourself, and it made it a % for some reason. So, okay, sorry, so let me show. This is a common problem in Excel. Look, I've got 1,000,000 decimals, and it's a %, and it shouldn't be. How do I fix this? So I right-click, and I go to Format Cells, and just change it to a number, and we'll just do 2 decimal places. And then I can double-click this, and it'll go back to normal sized. There we go. So now we look pretty similar here. If we do internal rate of return, we can do the same thing, but we do have to put the -7 in its own cell here. So there's a couple different, there's two ways to do internal rate of return as well. It gives you the same number. This is the most educational one, is to use solver. So internal rate of return is the rate of return such that the NPV is 0. So we can literally do that. We just go into data solver and we say make, right, select NPV to be 0. Right, give me a 0 by changing the rate. Go, it found the solution. Right, and see, okay, so now here, this doesn't look like 0, but it actually is, right? If I add digits, let me just show you if I add digits to this. It's, see, maybe if I change the format, it'll help. Number, there we go. There, right, you can see this is 0, right? This is less than a penny, right? Solver just quits when it gets close enough. Okay, so we got NPV to be 0, and now, right, we know our answer is close to 6%, but if I make this bigger, there we get 6.17%. So the answer is in the cell that's changing, right? So we go here, and that's where we get our answer from. Another version is to just say equals IRR, oops, equals IRR, and draw a box around your cash flows. Now this only works if you have one cash flow per year or per time period, and you include the initial costs up front on the left there. And then if we make this bigger, and get that. Okay, so that is the internal rate of return matched up right with the same as with this. But to get the correct NPV, we would need to change this back to 11%. And now we have our NPV answers there. So the question was, is this a good project? Good idea? Question mark. And the answer is no. Right? This is not a good idea because we have a negative NPV and on IRR below the cost of capital, right? We don't borrow at 11% interest to earn 6. That's not a good, it's not a good choice, it's not a good economic solution. So, okay, yeah, so that is the large capital budgeting example. So in the next section, we'll do an effective annual cost